All right, everybody, Steady Wealth Podcast here, Serge Berger for another episode. Today is very special. I know I say this a lot, but it really is special. Someone whose work I've been following for a number of years, whose latest book I've read twice over the past 12 months. Larry McDonald from probably it was the Bear Trap Support is probably the best place you're known for, obviously from the other books you've written, right?
Yeah, I mean, well, the first book has been published in 12 languages. It was a New York Times bestseller, and I'm really proud. It's in the top 20 all time at the CFA Institute. It's called The Colossal Failure of Common Sense. And I was a trader at Lehman Brothers, and it's like the Lehman inside story. And I tell my wife, once a month, I said, if we sell 1 million books, we'll break even on our Lehman stock. You know what I mean? So, but that's the big one. We sold, almost 1 million copies now.
Yeah, and then of course you wrote this bad boy, How to Listen When Markets Speak. Again, I read it twice, Larry, this past year, once over the summer and once before then, and I've been very enlightened to it. It's essentially, and I by all no means want to put words in your mouth, but I'm somewhat have read it twice, so hopefully it's resonated with me. But essentially, it's the higher inflation for longer theory and all the sort of side effects, and of course, there's other aspects to it. But if you don't mind, if you can take us kind of through the essence of what your base case is, a lot of people have heard off spins of that from me, and then we can kind of take it from there, if that's okay with you.
Sure. Well, when Lehman Brothers failed, it was the largest bank failure of all time. It was a financial crisis. It was like almost $750 billion failure. And it triggered this financial crisis that was violent in 2008-9. And the response to that, the fiscal and monetary response, was about $4 trillion from fiscal spending in Washington and then monetary from the Fed. If you look at COVID, plus the regional bank crisis of 2023, plus if you add in the election year last year, where the Biden team really juiced the fiscal spending, like another $2 trillion in an economy that was growing, right? A lot. So we did $2 trillion in GDP last year with, $2 trillion of deficit spending with like GDP that was at the according to the Atlanta Fed, was like 2.5%, 3%. So if you add up the fiscal and monetary response to that, to COVID, the regional bank crisis of 23, and then the fiscal juicing into the election, it comes out to $16 trillion. So it's 16 trillion versus 4 trillion. And when inflation gets above 5, 6, 7%, it gets under what I call in the book, under the seat cushions. It gets behind the curtains. It gets in between the sheets, and you can't get rid of it without like 8% unemployment. You just can't. If you look back every example through history. And so the problem is there's no political will to get like 5, 6, 7, 8% unemployment to kill inflation. So what they've done is the politicians are just supporting it, and they're like basically putting gasoline on the fire. Now, Elon Musk and the Doge team, they're going to try to do something. It's going to take a long time. It's just going to take a long time. Maybe in 4 years they can kill it, but for at least for the next 2-3 years, we're going to have very, very sticky inflation, slowing growth. That's stagflation. If that's the case, which we think it is, you need a whole new portfolio construction.
Yep, and that's exactly where I'm trying to get this to. Since you're already alluding to Doge and essentially, the new U.S. The White House administration, do you have a base case of inflation, sort of a range, is sort of 3 to 5%, or what is your kind of, anything above 2.5 gets you out of the 20-year trend, right? So I think that's something people don't appreciate.
Well, yeah, also remember that the only way out of a $37 trillion debt hole, the only way out, there's two ways. That you can default, you can go the Argentina route, or what we call it, in the Bible, they reference debt jubilees. Civilizations have gotten out of these problems typically through a debt jubilee, a reset, big default. Or you can monetize the debt. And that's what we call financial repression. And this is the deep, dark secret in Washington, what they're trying to do. And they won't come out and tell you this, but they are trying to massage interest rates below the rate of inflation. So inflation probably normalizes 2.5 to 4%, and they're going to try to get rates down below that. And if you listen to Scott Bessent yesterday, the Treasury Secretary, he's basically telling you that we're going to use financial repression. They're going to intimidate our trading partners. They're going to force Japan. They're going to do whatever they can. They're going to use banking regulation to force the banks to buy more treasuries. And they're going to basically massage interest rates below the rate of inflation. And when you do that, you inflate your way out of the debt.
Yep. So it makes a lot of sense. I know people will hear this. I'm not sure people understand how critical this is, but that's actually exactly the reason why I want to have you on. So you don't think, in terms of for example, Bessent's 3-3-3 plan, which is was it 3% of get 3% of deficit reduction to GDP? I think that's one. Then the other one was what was it? Let's see, I had to keep forgetting. I know the other was the oil print, the oil increase oil production 3 million barrels a day. You don't think that is going to lead to this all of a sudden miraculous end of inflation or whatever they're trying to preach in the near term? That's more of a longer standing goal they're trying to achieve.
Well, it's going to take them a while to get oil prices down, because if you look at the capital expenditures, so look at BP today. There's a news story. BP told the world they were going green like 5 years ago. And so they suppressed their investments in exploration dramatically. They cut them down by 45%. And they increased their green investments in renewables. And today they admitted that they have to reverse course. They miscalculated. There's 1 billion people in India that don't have air conditioning. We've exported 5 million jobs out of the United States. We've decimated the Rust Belt. 45 to 55-year-old men are dying in the Rust Belt, or just across middle-class America. The life expectancy of men between the ages of like 48 to 58 is crashing down in the United States because we've decimated these people. The U.S. We were talking about copper. We have to import close to 50% of our copper. 50%. We don't produce anything in the United States anymore. The globalists really made a horrific miscalculation. And the good news is we've raised the standard of living dramatically in India, Bangladesh, China. That's the good news. The bad news is we've created excuse me?
We've exported our standard of living, essentially.
Yes, but the problem is you got 1 billion people in India you have 1 billion people in India without air conditioning, and now you've raised that standard of living. Now you've got all kinds of new carbon consumers in the emerging markets, and that's all going to hit the world with like a sledgehammer the next 5 years. And that's why today Shell Oil announced that they raised again their LNG demand estimates, like for the 4th time, for liquid natural gas. And so that's natural gas. So natural gas is the only way, and nuclear is the only way to get to the green meadow. In other words, eventually, they told us 3-4 years ago we were going to be carbon neutral in 2030, 2035. Complete fantasy idiocy, right? The carbon neutral thing is good. They mean well. It's just it's like it's the year 2100, right? It's the year 2090. That's when we're going to get there. And the only way we're going to get there is through massive use of natural gas and nuclear and alternatives that have carbon.
Yeah. And so that's basically positive energy stocks is the kind of long and short of it, I think, and not to kind of take words out of your mouth, but I think that's kind of where probably trying to get to. And then
Well, remember, from 1968 to 81, we had a multipolar world, right? So we had more wars, just like today, high inflation. Neil Ferguson, I sat down with him for my latest book. Brilliant historian, Hall of Fame, really the GOAT, the greatest of all time financial historian, Neil Ferguson. We sat down. He's like, Larry, wars create long-term sustained inflation. If you look at the Ukraine rebuild, right? So we did a note this morning. If you want this note, just please reach out to me. Tatiana at thebeartrapsreport.com. Tatiana at thebeartrapsreport.com. It's an invaluable note because we looked at, so think of the rebuild. You've got the Gaza rebuild. Gaza has to be rebuilt the next couple of years, next 3-4 years. You've got the LA rebuild. You've got the Ukraine rebuild. You've got the US power grid rebuild. And then you have all these data centers that are requiring artificial intelligence computing. That's all. This is going to require tremendous amount of copper. And in the Ukraine, just the residential buildings that have been destroyed or damaged, 150,000. Okay. Educational institutions, over 3,000 have been damaged or destroyed. You go on and on and on. This is the Ukraine rebuild is probably like an $800 billion rebuild. Wars are inflationary because you fight the war and then you spend the next 10 years rebuilding to get out of it. And so to get back to the main point, this is from 1968 to 81, we were in a multipolar world with wars, and sustained inflation. By the end of that regime, 1968 to 81, the market was essentially almost flat, but commodities were up a lot. And at the end of the day, in 1980, 81, 49% of the S&P 500's composition was industrials, materials, and oil and gas. Industrials, material, and oil and gas. 49%. Within the last couple of years, that got down to 12%. Okay. And now, as we go back toward that 1968 to 81 regime with higher inflation coming out of wars, we're going to be back where, say, 4, 5, 6 years from now, those groups, industrials, materials, and oil and gas, they're going to become not 49% of the S&P, but are they going to become 30 to 35? Absolutely.
Well, the energy sector alone, I think, is currently 3.5% of the S&P, historically closer to 8 to 9. Tech is, if you really calculate it, close to 40. Mike, historically closer to 20. So some mean reversion, I guess, in either direction. I think what a lot of people are confusing right now, or getting confused as, is they see the headlines of, all this, I'm going to get down energy costs and this and that and the other. But a lot of that is really storytelling and maybe a longer term story than something that's going to come to fruition over the next, few quarters or so. So I think that's one thing that I'm always trying to caution people.
Yeah.
There's a huge misalignment of time frames that people have. What about that new portfolio that I guess we're just touching on it already? Can you go a little bit more into details on that? Obviously, we're not giving any investment advice here. This is purely educational. But so that new portfolio looks a bit more industrials, materials, and energy heavy rather than basically 50% or 80% tech, which most people have.
Yeah, that the evil part of passive investing, right? It's really evil because it's brainless, right? It spoils people. Human beings, when they get spoiled, they do bad things, right? You can just buy the S&P like an absolute imbecile and make money, and you don't have to listen to any conference calls. Don't have to do any thinking. You don't have to ask CFOs questions. Okay, there's zero responsibility. You've given over that responsibility, right? And the original intent with Jack Vogel and the whole thing was really nice and well intentioned, but it's an absolute horror show because once you get up near 60% of the market passive, 62, 64, there's more and more people that have absolutely no financial understanding, and the winners collect more and more capital. So right now, think of Apple. For the last 20 years, Apple spent most of its life anywhere between 2 to 3 times sales. In a bull market, maybe 3.5. And now in a bull market, because of passive, Apple's trading at 10 times sales. And it's absolute idiocy. And so you've got concentration of wealth. We're going to destroy everybody's 401k has been hijacked by complete and utter passive idiocy. And it's a train wreck just coming down the tracks.
Yeah. I mean, we had a quick catch-up call before this, like a day or two ago, I think it was. And I was telling you, like, honestly, one of my big reasons why I'm doing this podcast, one of the big things, I talk to the average investor, a lot of them are on the baby boomer side, and I see what they're invested in. I see it very clearly, and it is as exactly as you're saying. It is, in fact, it might be worse than a lot of people actually are aware of, like how concentrated these portfolios are. It's absolutely scary. And the concern I have way beyond that is that they're not even really willing to accept a different portfolio. They just, it's been going so well, right? As you say, that it's so scary that this passive stuff keeps building on itself, and it's on its own without thinking. Owning 5 stocks, they've done unbelievably well for a decade, right?
And that's the thing. The baby boomers today control. They're approaching 80. So the oldest boomers are at the golf clubs in Palm Beach and just outside of Los Angeles or wherever. All these boomers are in Nantucket. They have 80 trillion of wealth, and the oldest boomers are approaching 80, which is a big problem, because when you get older, you're going to start to own other things besides stocks. So that's a wholly other subject. But those people are sitting around the country club telling stories, and there's a line in the book, J.P. Morgan in 1907, right? J.P. Morgan in 1907. Think of these words. Famous quote. Said, "There's nothing in this world which will so violently distort a man's judgment more than the sight of his neighbor getting rich," right? So these people are sitting around the country club. They're sitting around the fireplace in Vail, telling each other how much money they're making in these FANG stocks, and everybody just over and over dosing into the same disgusting crowded trade. And like I said, it's a train wreck coming at us, and it's all going to unravel in the next 12 to 24 months.
Yeah. That's the time frame. And I think, again, we also live in the world where it's become more and more immediate gratification, right? It's like, what did Apple do today? You ask someone, what's your view on Apple? They'll say bullish. The problem is that question is nonsense. I didn't specify the time frame. Is it for the next 10 minutes? Is it for the next 2 weeks or the next 5 years? It's just bullish, right? Bottom line. And so I think people just are so focused on the here and right now, and they're not even really willing and open-minded to change. So I think the structural things you talked about in the book so well really resonate with me, because they are things that have been a long time coming to a head. And so just maybe a little bit more detail on that. But what role does gold, and I know a lot of people like to talk Bitcoin, and I don't want to go too crazy.
Yeah, so let's get into the gold and copper. But I'll end the passive thing with one amazing stat. So Warren Buffett had an enormous holding of Apple. Like, I think it was $900 billion. That
was his largest holding, wasn't it?
Maybe it was $1 trillion at one point. Yeah. He sold 75% of this stock, like almost 75%. And the stock at first went down, but then it went up. Mm-hmm. That tells you, like, if this had been done 10 years ago, the stock would have been down for maybe 4, 5, 7 years. But there's so much passive money coming in from, people buying 401ks and buying the S&P. And all that means is the money has to go into the top stocks, right? So when you have a $100,000 new investment in a 401k, that money has to go into the stocks, right? Into the top holdings of the S&P. Sure. And so that's what's created this, distortion. In terms of gold, gold is the most expensive to the miners in a long time. But what we've noticed this year is the miners are actually up like close to 10, 11% this year, outperforming gold. So you've got so right now, the miners are up 19% year to date, gold miners, and gold is up, the GLD is up 10. So you got about 9% outperformance in gold miners versus gold. And we think this is a trend for the next year because a lot of central banks that have been hit over the head with sanctions over the last 15 years, the United States government has hit country after country after country over the head with the billy club that are sanctions. And so now we're forcing big central banks into owning gold, and that's what's created this massive distortion. Gold is crushing the S&P the last couple of years. It's crushing the Nasdaq. Agnico Eagle, which is a gold miner, I think is outperforming Microsoft by like 40% over the last year and a half. And so,
well, and if you volatility adjust gold, the 40% run we've had versus, let's say, the Nasdaq, although that's been very low vol too, but it's crazy. It's even crazier, I should say.
Oh yeah, no, yeah. Gold's biggest drawdown in the last 10 years is 22%, and the Nasdaq was down like 37% in 2020. It's alone, so yeah, the volatility adjusted is not even close.
Yeah. Quickly on the I want to quickly go back on the copper thing because I know no one is interested or allocated in any meaningful way into materials, right? So you mentioned some copper stuff, gold. What else goes into that? Uranium you mentioned, right? One thing that we should say, and I know you touch on it in the book as well, that stuff can be volatile. So I just want to quickly disclaim
so
that.
This is really important. So we did a note today about cognitive dissonance in copper. And once again, it's Tatiana at thebeartrapsreport.com. We'll send you the note. You got to get this note. Yep. For the last 30 years, whenever economic stress started to approach, the bonds rally violently first. The transports typically rally. This all happened before COVID, before Lehman, because the transports and bonds are like your ultimate canaries in the coal mine. And the third is copper. Copper is going to underperform because for the last 40 years, when you had any kind of economic contraction or austerity coming in from Washington, Doge, the whole thing, copper, bonds, transports are going to react first. This has been going on for 30 years, right? So that's a firmly held psychology belief. It's like a firmly held belief, almost religious in the market, because every investor has seen copper and oil stocks get destroyed in recessions, right? So everybody knows that. A 5-year-old knows this. A 2-year-old knows this.
And it's happening a little bit right now, right? So you're seeing that again, but you're saying that maybe that's not going to be.
Well, that's the point. That's why we get the cognitive dissonance. It's a psychological phenomenon that occurs when an individual holds two contrary or contradictory beliefs, like two things that go against each other. You get a conflict in your mind of two beliefs. And so you've got this belief system of 30 years. If you get an economic slowdown, bonds rally, transports, economic slowdown, copper gets killed. And so that's one belief. But then you have these data centers, right? So we're going to spend $2 trillion on data centers. Microsoft, Google, Apple, Amazon, Meta, $2 trillion from 2023 to 2027 or 8. The total number comes out to $2 trillion for data centers. And it's going to require the copper is going to be needed for these data centers. It's going to be like 400,000 metric tons. Okay. But then you've got the Gaza rebuild, the Los Angeles rebuild, the Ukraine rebuild, and the U.S. power grid right now. The U.S. power grid is 30 to 50 years old in many different spots, right? And then you have robotics. All these robots are going to replace human beings in Amazon warehouses. Oh, really? Take a guess how much copper's in robotics. So this is a complete and utter, I hate to use the term, this is a shitstorm. This is an absolute utter crisis in 2027, 28, because it's going to be like, you can't have a country like the United States that imports 50% of its copper that is going to spend $2 trillion on data centers. because the data centers need tons and tons of copper. This is this is a massive contradiction.
Yeah.
And that's why the best investments over the next 5 years, 10 years, all the money, all the idiot money has gone into the AI stocks, right? And that's the obvious trade. But the real money that's going to be made over the next decade is in the COPX, your Freeports,
Yeah.
your tech resources, companies that own these large copper mines that are going to have oligopoly type power, because you're going to have so much demand for copper, and the profit margins are going to be incredible.
Yeah. And I've been preaching about exactly that too for a while. It's challenging, and that's why when I again thank you already for being here, because it's such an important point to be thinking ahead. You know, markets live in the future. We're not seeing that too much yet in the copper price and things like that. But you know, I'm trying very hard to get people to start thinking about maybe it's time to change my all AI, all Mag 7 stock. And then you ask people, well, I don't have only Mag 7s, but the correlation, my friend, is all to those stocks, right? That's the passive thing you're talking about.
Yeah, and we just came through a China property crisis, right? We had all kinds of economic stresses in Europe with the war. And so you've had this massive amount of negativity on kind of industrials or metals because of this like negativity. And now you've got this Doge coming in. You've got economic slowdown in the United States because we have a huge problem. We did 2 trillion of spending last year, 1.9, and then President Biden spent another 800. That's deficit spending. So we did another 800 billion in the first quarter. So we're looking at like a $700 billion fiscal cliff. And that's what's suppressing copper, all these things, because copper is looking at China, it's looking at all this negativity. And that's why if you look at the COPX versus the market, it's at a really wonderful inflection point. If you look at the gold copper ratio right now, we have this in this report, Tatiana at the beartrapsreport.com. We can send you the report. We've got the gold to copper ratio. It's in the screaming buy zone for copper. It's at the very, very low end of the 30-year range. It's at a point where you want to be selling down some, say you have whatever it is, $1 million in gold, $100 in gold. You should take 30% of your golds and sell it and buy some copper,
Yeah.
or buy some copper producers.
And COPX, by the way, is the copper miners ETF.
And it's a good one. I mean, if you look at that, what I like about it is the largest holdings is only 6%. First Quantum's in there at 5%. BHP's at like 4.9%. That's what I was mentioning earlier. Like in 2030, we're going to see a BHP in the top 10 names in the S&P. We're going to see maybe a Barrick Copper Gold. Barrick is now a big copper producer, much bigger than they were 5 or 10 years ago. But if you look at the composition of the S&P 500, those top 10 names, there's not one company in the material space. Whereas in 1980, 81, you had a lot of companies in the oil and gas, material space, industrials that were in the top 20 stocks. And so that's where we're heading. We're heading to a period where your Rio Tintos, your BHPs, your Barricks, your Freeports, these are going to be a much bigger part of the S&P 500.
Well, Larry, I want to be respectful of your time. One thing that last question, what do you say to someone who has had such a great ride on these Mag 7 stocks, which clearly are good companies, but we should probably differentiate between company and the stock price? Obviously, we can't give advice here, but what would sort of be your real short sort of message to them if you were to summarize our discussion?
Okay. Well, first of all, there's definite warning signs. Microsoft is underperforming, say, Berkshire, where Berkshire's portfolio is very energy materials sensitive, but Microsoft is underperforming Berkshire by a lot in the last like 12 to 18 months. So there's definitely a rotation already starting, first of all. The other thing I would say is if you look back historically, no one's ever made money looking in the rearview mirror. You want to look forward. And if you think of like Mag 7 companies, just look at Apple this week. The president of the United States called Tim Cook, and he basically forced Tim Cook to, right now, Tim Cook and Apple are producing a lot of their iPhones in coal producing countries like China. China's using 3 times more coal than the rest of the world annually, right? And so Apple's been producing all those phones with cheap labor and cheap coal. And the political pressure on Apple, because we had this election and a big political shift of that's what we talk about in the book. The political shift in the United States toward reshoring is gone from President Obama and Romney both Romney and President Obama told us in 2012, those jobs are not coming back. Yep. There was like this defeatist mentality toward globalization, both Republicans and Democrats. Now, both Biden and Trump have been pounding the table on reshoring. That's a lot more inflationary. And when you reshore, for companies like Apple, your profitability of making iPhones is going to collapse. Plus, you're in a higher interest rate, higher inflation regime because you're reshoring. It's a lot more expensive to produce all kinds of products from underwear to iPhones. And so if you look back historically, when you're in that higher interest rate, higher inflation regime, if you look at what we call the DCF model, that measures like how expensive stocks are relative to the risk-free rate. And all that means is when you go into a higher interest rate, higher inflation regime, the stocks that people on Wall Street start recommending are companies that own assets in the ground, companies that own natural gas deposits, that own gold, that own silver, that own copper. And so that DCF model, a discounted cash flow model, if you're looking at growth stocks versus so your big tech companies versus your big hard asset companies in a higher interest rate, higher inflation regime, it's a historical fact that capital flows from growth to value and from what we call growth stocks over to hard asset type companies in that kind of elevated inflation, higher interest rate regime. And since 2020, we've entered this new regime. And if you look at any chart comparing industrials versus the Qs outperform the industrials and say Berkshire for every single year for 10 years in a row in a disinflationary regime. Now, as we've moved from 2020 to 2024 into a more sustained inflation regime, all of a sudden the industrials, all kinds of metal companies, gold, are starting to outperform growth stocks. And this is a trend that's just starting. We're in the early innings.
Yeah. Well, there's a lot to unpack here with all the knowledge and research and experience that you're dropping. So I hope everyone took some notes. I did. And I hope everyone's going to reach out to Tatiana at the Bear Traps Report. I've had the pleasure of interacting with her. I'm going to actually ask you for that report as well. What's the title of the report? Do you recall?
Well, it's just today. We do the turning point on the weekend.
Yep.
But overnight, it's a copper report that's in our overnight note, which is like an institutional recap. But the turning point will also have the same type of data, and that'll come out on Sunday.
So if they say copper report, she would know.
Yeah. I'll tell Tatiana.
Okay, perfect. Larry, it was a real great pleasure. And again, everyone, I'm not getting any kickbacks for this, and that's not the point, but it's just an unbelievable book. I really encourage everyone to read this. Larry, thank you so much. I really appreciate it.
Appreciate it. Thanks for taking time, Serge.
Hey there. I hope you found this video helpful. Now, please make sure you click up here to get much more of our great videos, our great insight into the markets, analysis, and excellent interviews with professional traders and investors.